Hi, and welcome to The Full Perspective. I'm Charlie Thomas, the Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into the week's most significant stories. Today I'm joined by Insurance Insider's Editor-in-Chief Adam McNestrie and Inside P&C's Director of Research, Gavin Davis. Hi guys, thanks for being with us.
Hey Charlie.
Hi, Charlie. I have to apologize again for my appearance. Until I'm allowed to go to a barber and go to my apartment to get my business attire, I'm socially distancing from my self-esteem.
I like that description. I'm going to nick that. I'm totally using that. I would like to start this week's episode with the phenomenal amount of fundraising activity we've seen across the reinsurance and direct spectrum over the past few weeks, totaling more than $3 billion in the public markets alone and a whole host of private scale-up startups and buy-ins. Adam, why don't you take us through what you think is going on here?
Sure. There's been a remarkable flurry of activity over the last few weeks, and in particular over the last week. We'd already started to see public companies tapping the markets for money, a bunch of it in London, some of it in Bermuda. And then what we've seen over the last week or so is some of what we've been flagging up crystallizing. So about a month ago, we wrote about the fact that private equity houses were circling the space. They were ringing senior leaders, they were reading brokers, they were trying to assess the opportunity, and they were trying to profile potential leaders. And there were some possible leaders for businesses who were starting to weigh up their options and think about it. That's moved on apace over the last few weeks. And I think it's going to sort of continue to roll. I think one of the interesting aspects of this is the fact that we're seeing new capital formation here, but without any real recognition to date of distress in the sector. Ordinarily, what you would expect is that significant losses would show up for businesses. There would be pain. There would be businesses that were struggling to underwrite what they were underwriting before. And then you would see a combination of capital raises to repair the balance sheet for incumbents and new capital flowing in that didn't have those problems. I think we're seeing something a little bit different this time. And I think it's like everything else, it's a function of COVID-19 and the nature of the loss. So you don't have something that is a big single quarter hit where you know fairly quickly what it looks like. Everybody has a sense of what the opportunity is, and capital rushes in, and you get new co-formation. I think you've got something here that's a live cat, and it's also a live cat of very uncertain size. It's also highly uncertain how the macroeconomic environment is going to develop and the way in which those things influence each other. So I think you've got a great deal of uncertainty. I think that creates capacity constraint, appetite constraint, and I think that pushes rates. And I think that the money is just following the rates at the moment. They see a positive story in a broader, challenging economic environment, and then they're looking to come in. They're looking for an access point.
There's a lot of big names behind some of these startups and scale-ups and stuff as well, right? So private equity is clearly going for the big, trusted, proven experts in our field that they want to go and back as a proven thing.
Right, and I think you see that all the time. So if you look at what Dinos Iordanou is doing, the Arch founder, the money that he seems to have lined up from H&F and Carlyle, there are personal connections there. There are people who look as if they're going to back him, who backed him before at Arch and have made money there. If you look at Ed Noonan's return, the buy into Starstone US that he's doing with Jeff Consolino, again, he's backed by Cornerstone money that has worked with him before. Aquiline backed Validus. PE is taking a bet on a management team more than anything else. And they like to work with people with proven track records. I wonder whether you'll see the same thing with Martin Reithenaway. Martin has a slightly strange history when it comes to PE, in that he has raised more money but not deployed it than any other person in the history of insurance. I think it was something like $5 or $6 billion in total that he raised after he left Ascot for different opportunities over time from a whole host of names: Warburg Pincus, Blackstone, Stone Point, Capsea. And he didn't have the opportunity to deploy it, and then the money was ultimately sort of dropped away. So he has a lot of relationships, and I wouldn't be surprised to see him pop up with money from one of the names he's worked with in the past too.
I would also just add, the sort of interesting thing is people talk a lot about capital scarcity being one of the binding constraints on industry's supply and demand. If you look at what's happening and everything you just said, I actually think one of the more important binding constraints will be availability of talent and availability of bankable management teams. And some of the early ones we've seen are pretty highly stacked with respective figures. I'm not sure how deep that bench goes of people on the sidelines who people are dying to give money to. And that might be a gating factor for. There's clearly a lot of capital that wants to get in, but that might be a pinch point.
I think that's definitely true. I think that there is it's a bottleneck, the amount of management that has track record and credibility is there. I was speaking to a banker who's sort of looking at and trying to figure it out, who are the backable figures in the sector, and they said, well, there's no John Charman. There's kind of not that sort of available figure. I think they were probably in the know about what Ed Noonan was doing already, and yeah, so I think that's definitely going to be an issue. I think there are other issues around it as well, right? Which is, what is the right access point for the money? And you referenced scale-ups v startups v buy-ins, Charlie, and I think there are interesting dynamics around that as well. So, and you have all of those things going on. I think it's worth mentioning at least the challenges and constraints that de novo startups will face. It takes a long time to get to market. Speed to market matters when the market is transitioning, and it takes time to set up the legal entities, to get the licensing in place, to hire the teams, to wait for their restrictions to fall away. And it just takes time in general to build an insurance business as opposed to a reinsurance business. You can't just slap down a few lines on big pro rata deals and get the premium volumes coming through and earn them quickly. So I think we will probably see a couple of those because there aren't the quality assets available to acquire. But I think they'll find it hard.
The only other thing I'd add is a couple points to say, which is, one, though there has been a lot of activity and a lot of individual instances, the actual total amount of capital raised to date is actually quite low. We're talking, 4 or 5 billion if you sort of say everyone gets there. That's not a huge heck of a lot. And the other thing to say is this also should be seen in the context of capital exiting the business or being trapped. We talked a lot about it inside P&C around a non-functioning retro market, and this may be, as much as this is capital raising, maybe this is really about a rebalancing or an untipping from one market to another. And as retro becomes unavailable, you need other forms of capital to support your risks, and maybe some of that risks flows back into some more traditional channels rather than alternative structures, and you need capital to support that. And maybe what we're seeing here is a little bit of rebalancing rather than actual net flows. I don't know the answer to that, but I think we need to bear in mind that there is also money going out the back door.
Yeah, that's definitely something to consider. And I thought the other interesting point from coverage this week was that, you were hearing that certain sources were feeling the heat from ratings agencies a little bit, and we're expecting that, post-crisis, some reinsurers might be expected to hold more capital. That's an interesting dynamic at play here too.
I think there's been a little bit of talk about it, but there's possibly been contradictory talk about it. I was just speaking to a CEO of a major insurer and reinsurer a moment ago, and they said they haven't seen that at all, and they don't expect that. So I don't know whether that's a case of kind of good company, bad company. What's your, how geared are you to cat risk? But so I don't think that's a given. But certainly in past instances where ratings agencies have got access to new information about risk, they've pushed people to hold more capital after the event. And here is a risk that was clearly not well understood by the marketplace, and certainly possible. Therefore, people will be asked to hold capital against it in future in a bigger way.
I would add just an observation, which isn't based on intel from talking to anyone, but just an observation based on what we've seen. You can clearly see that the rating agencies have been tougher on primary insurers in Florida, and I think if you think how that fits into the value chain and flows into reinsurance and retro, some of this is definitely rating agency aftershocks, and some of that is actually aftershocks from losses from several years ago that sort of slowly works its way through the system. And the other thing to say is I think partly with the risks around COVID and the large losses in recent years, I do think some of the rating agencies, might be in CYA mode a little bit, and looking at some of the people who are weakest and thinking, well, they need to draw a bit of a line in the sand, make a show of showing that they're going to be a tough grader and just keep people on their toes.
Okay, that's great. Well, let's keep a watching brief on that one for now. So we're going to move on to my favorite piece of coverage this week, Lemonade's prospective IPO. For those of you who may have missed it, the SoftBank-backed InsurTech filed its S1 on Monday, a little over 6 months after it shelved a previous attempt to list. Gavin, why don't you give us a brief overview of IPC's take on this story?
One of the things you say about Lemonade is it's very controversial. People either love it and they think they're going to revolutionize the entire industry, or they think they're a hype factory and they think that they have created a really cool renters product. I think everyone believes that who's looked at it. I'm a customer and I agree. But think that they will have challenges if they try to scale that into other markets. So I think one of the first things to say is, looking at the S1, they're clearly trying to target the growth and tech investors and making no concessions to try to win over their critics. they say almost explicitly as much that you either kind of believe the story or you don't. And they're talking, a lot of the language is around the 5 trillion addressable market and how they're starting in renters, but they're going to expand into other markets along the way. We made a few points in the piece we put out this week, but I want to focus on just two, which is one on reinsurance and first on addressable market. And the key thing about the addressable market is to say, the first area they focused on renters was actually really clever. It was a really underserved market. Most carriers really struggle to do it because of the low premium involved and the fact that they struggle with the admin fees alone. But it's actually a relatively small market, right? It's 3.5 billion in premium. That's not a million miles away from the valuation they raised in the last round. So I think it's almost inevitable, but we learned from the S1 that they have bigger ambitions to go beyond that. Here's what the problem is, though. They talked a lot about basically building a big renters business and building that market share and building a big book of younger people. 70% of their book, they say, are under 35. The problem is converting those to homeowners is going to be a hard game. I mean, the first thing, they say it explicitly in the risk factors. They said our business model is premised on expanding into other lines, including homeowners. It's not a nice to have, it's a need to have. They need to increase their premium per customer to make the economics of their business model work, because they're spending so much to acquire the customers that unless they take up the lifetime value of them, they're in trouble. And so I want to make a few points about the problems they will face doing that. The first is homeowners is just a different business to renters. We talked just a second ago about how renters is kind of this niche underserved business. That's not true in homeowners. It's a competitive business with a lot of mutual or low cost of capital serving that well. The second is there's a lot of decision points that when you go through buying a home, there's a lot of people involved in that process who are highly incentivized to try to get you to make a decision around insurance. Decision points lead to shopping. Shopping means that there's just other ways you might go with it. Another is complexity. This is a big decision and a big asset for most people. A lot of people just want to CYA that decision and get an agent involved. Another is bundling. A lot of people bundle these products. And as long as Lemonade doesn't have things like auto and other products, they may suffer from an ability to serve their customers. And the final is claims. One of the cool things about Lemonade is they do these quick triage 3-second claims. That's just harder to do when the claims get more complicated and when people are involved and when there's liability involved or unknown costs of repair in a catastrophe, when there's struggle getting access to adjusters and costs and all that stuff. So I just think it's a more complicated business, and it's not a given that if you can make it work in renters, that you immediately can transition to homeowners. So that is a big bet that people are making, that when they say, hey, I'm betting on Lemonade that they'll figure it out, they've got a lot to figure out. They're smart people, they've done a great job with renters, but you are making a big bet.
Sorry, I was going to say, where's Adam on the Marmite spectrum of Lemonade then? Are you like a believer, or are you a bit more of a cynic?
I don't know. I think there are big advantages of incumbency, and I think there are big challenges for incumbents as well around legacy, around culture, around transformation. I'm going to sort of reserve judgment at this point. I suppose one of the things that does strike me listening to Gavin is if you have something which has good technology and an excellent user experience, which are huge advantages that are lacked by many insurance companies, and they're struggling to find a way to use their renters market as a beachhead into the broader personal lines, potentially commercial line space. Do you have an opportunity there potentially for a big strategic who does have that distribution, who does have that customer base, to come in and buy the business? I mean, this was something was talked about a couple of years ago. I don't know how much substance there was to it, but there were rumors that two major strategics looked at Lemonade a couple of years back, and nothing seems to have come of that. Whether there was substance to it or not, I don't know. But I could certainly see why an existing business, maybe if you think about the analog as being what Travelers did with Simply Business, might think that they could buy and fold in Lemonade, use the technology, use the UX, potentially leverage the brand.
It's not impossible in this business. What is impossible? I think the stumbling block would be valuation. Now that they've just raised so much money at a high valuation, and what they're bringing to the table in terms of premium. What was that, 100 and something million last year? They're growing a lot, and they've got a big millennial customer base, and people may look at that's an opportunity. I'm not sure. I mean, one of the things I was going to mention, and I think this would relate to how an incumbent would look at them, is they say their business model is about retention and building a big pipeline of millennials that they want to sell to down the line. They're spending a lot of money to doing that. They're spending, I think, 90 million on their marketing budget last year to generate this growth. The problem is they say it's about having a great experience and retention. The retentions they disclosed in the S1 weren't actually that good. I actually think, adjusted for non-renewals, it was 62% in first year and 71% in second year. That actually means you're losing more than half your customers over 2 years. And that's fine. You can have a good business doing that. People who serve non-standard auto wouldn't look at that as terrible, but it means you can't spend a lot of money on acquiring those customers. You've just got to sort of churn them through and recognize where you are. the other thing to say is if you're serving urban millennials and you're concentrated in those markets, they don't seem to be high propensity home buyers. I'm not necessarily sure if that's where your destination is. That's where you would pick as your starting point. And as we'll go into it, also if you're trying to build a well balanced homeowners book, I'm not sure you want to do that by concentrating in niche urban areas. It tends to lead to risk aggregation issues and a higher reinsurance cost, which maybe we'll get into.
Yeah, I was going to say, I think that's the other point that we do need to get into, which is the heavy reliance on the reinsurance market for capital. And I think what you're seeing there is that just like investors, reinsurers are being asked to take a bet on a big idea and a future, and they're paying up front for it. They're paying up front for it in terms of losses that they're taking. And I wonder whether you haven't seen relatively substantial churn around the reinsurance panel already through Lemonade's lifetime. And look what's happening in the reinsurance market right now. Reinsurance pricing is volatile. It's starting to move in a major way. And Lemonade talked about removing volatility from the business model. Well, being dependent on an outside source of financing, with reinsurance, is going to create volatility within your business model.
I think that's right, and I think you say that it's a challenge all the people in this sector have is they want to own the distribution. That's the valuable part, but you can't own the distribution if you want to do end-to-end instant bind and quote, because you just can't plug into the other carriers. So what have they done? They tried to have their cake and eat it too by doing full stack, but then hedging the risk to reinsurers. The problem is, does that scale over time? Like the bigger you get, are you going to get underpriced reinsurance and handle losses and not see that adjusted over time? The second point is the more you shift to homeowners, the more that becomes a peak risk, especially if you're aggregated in urban centers, as they seem to be so far from what we can figure out. That becomes a more expensive source of capital. Yeah, and the final thing to say is, if you could do this at scale, this is a bit like fantasy stock picking, where you think you can make these big bets and win. The things that you can do with a small bet in a small market is different to what you can do at scale in a big market. There's just not the capacity there for you to do what you think you might be able to do. Otherwise, there's not a homeowners insurance company in America who wouldn't take 25% fixed margin, no risk, if it was being available to them. There's an arbitrage in small markets, but not in big ones.
Yeah, that's a good point. I just think one other thing to kind of bear in mind is, this is a busy period for US IPOs, right? I think I read somewhere in one of the financial presses that this last week has been the busiest throughout 2020 for US IPOs after quite a dearth of launches. So it'll be interesting to see, given that Lemonade hasn't actually given a timetable for its IPO, whether it does list or whether it decides to pull it from the table.
I think you're seeing that, to link that back to what we said before, you're seeing it across every aspect of capital. You're seeing it in debt issuance, preferred issuance, and capital raises. Capital markets look like they were seizing up, and people are nervous about COVID in general. You may as well raise capital when you can, and so people are looking to do it while the valuations are high and while capital markets are in generous mood. So it makes sense. They're connected.
No, definitely. Okay. Well, look, unfortunately, that is all we've got time for this week. That flew by. Thank you very much to Adam and Gavin for joining me today. Thanks, guys.
Thanks, Charlie.
Pleasure.
And thank you to all of you watching at home. Until next time, stay home, keep safe, and we hope you'll join us soon for another episode of The Full Perspective.